Most people believe markets react to news. A headline appears. Prices move. Bad news pushes markets down. Good news lifts them up. That explanation feels intuitive, and it is also incomplete. In reality, markets rarely react to information that everyone already sees at the same time. By the moment a headline reaches your screen, it has already been processed, debated, and priced by participants who operate far ahead of public attention. Markets do not fear bad news. They fear structural change, the quiet shifts that alter how a market functions beneath the surface. Those shifts don't arrive with breaking alerts or dramatic language. They often appear as routine adjustments, changes in participation rules, subtle shifts in liquidity, or mechanical pressures that only become visible when stress builds. Most investors focus on price because price is visible. Professionals focus on mechanics because mechanics determine how price is allowed to move. When the structure of a market changes, price behavior can change suddenly, even if no obvious headline explains why. That is often when volatility feels confusing, disproportionate, or disconnected from the news cycle. What matters in those moments is not prediction, it is awareness. Understanding where pressure is building before it expresses itself is what separates reactive decision-making from disciplined analysis. Today is not about forecasting outcomes or assigning blame. It is about recognizing a shift that many are overlooking and understanding why markets tend to move before most people realize something has changed. Over the past several weeks, the silver market has experienced heightened activity across futures positioning, inventory reporting, and delivery mechanics. Silver futures traded on the COMEX, part of CME Group, entered February with elevated open interest in the March delivery contract. Open interest represents the total number of outstanding futures contracts that have not been closed or rolled forward. Each COMEX silver futures contract represents 5,000 troy ounces of silver. As February progressed, market attention shifted toward the March contract's first notice day, scheduled for February 27th. First notice day marks the point at which holders of long futures positions must be prepared to accept delivery of physical silver if assigned. During this same period, CME Group continued to publish daily warehouse stock reports, which separate silver inventories into two categories. Registered silver, which is approved for delivery against futures contracts. Eligible silver, which meets exchange specifications but is owned by third parties and is not automatically available for delivery. Recent warehouse reports show that registered silver inventories have declined compared with prior years, while total inventories fluctuate daily as metal moves between categories or leaves exchange-approved vaults. In parallel, delivery data for the current month indicates a higher volume of physical silver being delivered relative to some prior months. Delivery volumes reflect contracts that were held through settlement and resulted in physical metal transfer rather than financial offset. At the same time, CME Group has adjusted margin requirements for precious metals multiple times during February, citing elevated volatility. Margin requirements determine how much capital traders must post to maintain futures positions and directly affect leverage participation. Compared with earlier periods, the combination of elevated open interest, declining registered inventories, increased delivery volumes, and rising margin requirements represents a change in market conditions rather than a single isolated event. None of these data points, taken individually, imply a specific outcome. Together, they describe a market experiencing tighter mechanics, higher capital requirements, and increased attention to physical settlement timing. These developments form the factual backdrop against which current silver market behavior is unfolding. To understand why recent developments in the silver market matter, it helps to separate price movement from market function. Price is the visible outcome. Market structure determines how that outcome is produced. The first-order effect of elevated open interest and declining registered inventories is mechanical pressure on the futures market's delivery system. Futures markets are designed so that most positions are closed or rolled before delivery. When a larger than usual share of participants choose to hold contracts through settlement, the system must rely more heavily on its available deliverable inventory. This does not automatically create shortages. However, it increases sensitivity to timing. The closer a market moves toward first notice day with high open interest, the less flexibility participants have to adjust positions without affecting liquidity or margin requirements. A second-order effect emerges through risk management responses. Exchanges adjust margin requirements to control leverage and volatility. These adjustments are not directional judgments on price. They are tools to manage exposure. When margins rise, some participants reduce or exit positions due to higher capital costs, which can amplify short-term volatility regardless of broader fundamentals. Another second-order effect involves behavioral shifts among participants. When delivery volumes increase relative to historical norms, it suggests that some participants are prioritizing physical settlement rather than financial offset. This changes the composition of market demand, even if total demand remains unchanged. Industrial users, hedgers, and financial participants respond differently to delivery mechanics, and those differences influence liquidity patterns around key contract dates. Beyond the futures market itself, there are downstream implications for related instruments. Exchange-traded products, options markets, and over-the-counter hedging arrangements reference futures prices and liquidity conditions. Changes in futures market mechanics can therefore affect pricing efficiency and hedging costs across the broader silver ecosystem. Importantly, these dynamics operate independently of headlines. They are not driven by news events, sentiment shifts, or narrative catalysts. They arise from the interaction between contract structure, inventory availability, capital requirements, and participant behavior. This is why professional analysts focus on process rather than prediction. Understanding how pressure builds within the system helps explain why markets can experience sharp moves without a clear external trigger. The key point is not that a particular outcome is inevitable. It is that the margin for error narrows when multiple structural factors align at the same time. In those environments, markets tend to react more strongly to incremental changes because flexibility has already been reduced. That is why these developments matter, not because they guarantee a specific result, but because they alter the conditions under which price discovery occurs. Periods of stress in the silver market are not new. What changes over time is the context in which that stress appears. Historically, silver has experienced episodes where futures market activity, delivery mechanics, and exchange-level risk controls interacted in ways that produced sharp price movements. Two frequently cited examples are the late 1970s to 1980 period in the 2010 to 2011 cycle. In the late 1970s, silver prices rose rapidly amid inflation concerns and strong speculative participation. Futures positioning became increasingly concentrated, and the exchange responded by altering trading rules and margin requirements. Importantly, the stress emerged before the peak in price, not after. Structural changes preceded the final outcome. In 2010 to 2011, silver again experienced a rapid price advance. Open interest expanded, retail participation increased, and volatility rose. The exchange responded with a series of margin increases over a short period. Liquidity tightened, leverage was reduced, and prices corrected sharply. Once again, the key developments occurred during the buildup, not as a reaction to a final event. These historical episodes share several similarities with the present environment. Rising futures activity relative to prior periods, increased attention to delivery mechanics, active use of margin adjustments as a risk management tool. However, the differences matter more than the similarities. In earlier cycles, exchange inventories were generally more ample relative to delivery demand, and industrial demand represented a smaller share of total silver consumption. The market structure was less influenced by globalized supply chains and just-in-time industrial sourcing. Today, silver plays a larger role in electronics, energy infrastructure, and manufacturing processes that depend on consistent material availability. At the same time, modern futures markets operate with higher speed, greater participation diversity, and more complex risk controls. History does not tell us what will happen next. What it does provide is a framework for interpretation. It shows that markets tend to experience their greatest instability not at moments of maximum attention, but during transitions, when participation patterns shift, rules adjust, and liquidity conditions change. The purpose of historical comparison is not to predict repetition. It is to recognize that market stress often builds quietly, long before outcomes are clear. Understanding that distinction helps investors avoid reacting emotionally to short-term moves and instead focus on how current conditions differ from past environments, not how closely they appear to resemble them. When markets move into periods of structural stress, professionals do not ask, "What will happen?" They ask, "Under which conditions would different outcomes become more likely?" That distinction matters. Below are three conditional scenarios based on current market structure, delivery mechanics, and exchange-level risk controls. These are not predictions. They are frameworks for understanding how outcomes could diverge depending on how conditions evolve. Bull case, structural tightness persists. If a larger than average share of March futures positions remains open into and beyond first notice day, and if registered inventories remain stable or decline further relative to delivery demand, then futures market participants may continue to price in tighter, near-term availability. In this scenario, higher margins do not fully reduce participation, and delivery demand remains concentrated among a subset of participants with sufficient capital. Liquidity remains available, but price discovery reflects greater sensitivity to incremental changes in positioning. Strength in this case is driven less by sentiment and more by mechanics, delivery timing, inventory utilization, and capital costs. Importantly, this outcome does not require panic, headlines, or speculative enthusiasm. It requires only that existing structural pressures remain unresolved. Base case, adjustment and stabilization. If open interest declines as positions are rolled or closed ahead of delivery, and if margin increases successfully reduce leveraged exposure, then pressure on the delivery system may ease without significant disruption. In this scenario, inventory levels fluctuate but remain sufficient to meet delivery obligations. Volatility moderates as participation normalizes and liquidity conditions stabilize. Prices may consolidate or retrace without signaling broader structural stress. Market function remains intact, and futures prices continue to serve as the primary reference point for silver pricing. This outcome reflects how futures markets are designed to behave under elevated activity. Risk is absorbed through capital requirements, position management, and time. Bear case, rule-based intervention dominates. If volatility accelerates sharply, and if exchange risk controls intensify through additional margin increases, position limits, or contract specification changes, then participation may decline rapidly, particularly among leveraged traders. In this environment, price movement can become disconnected from underlying fundamentals in the short term. Forced position reductions can amplify downside moves regardless of inventory conditions or delivery demand. This scenario does not imply market failure. It reflects the exchange's mandate to prioritize system stability over price continuity. Historically, such interventions have reduced volatility by compressing participation rather than resolving structural imbalances. The key risk in this case is timing, not direction. Participants positioned for immediate outcomes may be forced to adjust before longer-term dynamics reassert themselves. Why scenarios matter? None of these scenarios exist in isolation. Markets can transition between them quickly as conditions change. Professional analysis focuses on probability weighting, not conviction. The goal is not to be right about the future, but to remain positioned for multiple outcomes without relying on a single narrative. That approach reduces emotional decision-making and increases resilience, especially in environments where structural factors matter more than headlines. When markets enter periods where structure matters more than sentiment, the most important signals are rarely the ones trending on social media. What matters is flow, positioning, and constraints. Here are the indicators I am actively watching, not to predict outcomes, but to understand how pressure is evolving inside the system. Open interest by contract month. I focus less on total open interest and more on where that interest is concentrated. Elevated open interest close to first notice day carries different implications than open interest spread across deferred months. A decline in open interest ahead of delivery suggests successful position adjustment. Persistence indicates reduced flexibility, registered versus eligible inventory trends. Daily warehouse reports provide insight into deliverable availability, not just total metal stored. I am not watching absolute levels in isolation. I am watching rate of change, how quickly registered inventory is moving, whether metal is being reclassified or exiting the system, whether declines accelerate or stabilize around key dates. Trend matters more than headline numbers. Delivery volumes relative to historical norms. Delivery data helps distinguish between routine settlement and structural stress. Higher delivery volumes do not imply shortage on their own. They do indicate participant preference, whether contracts are being treated as financial instruments or physical claims. That behavioral distinction matters. Margin requirement adjustments. Margin changes signal how the exchange perceives volatility risk. I watch. Frequency of margin changes. Size of adjustments, timing relative to price movement. These changes affect participation before they affect price. Liquidity and volume behavior. Price moves without volume often reverse. Price moves with constrained liquidity behave differently. I look for gaps in order flow, reduced depth during active hours, asymmetry between up volume and down volume. These are signs of mechanical stress, not emotion. Macro crosschecks, context not triggers. Finally, I monitor broader inputs such as US dollar index trends, Treasury yield volatility, inflation data releases, not as drivers but as background conditions that can amplify or dampen market responses. The purpose of watching these indicators is not to forecast price. It is to understand when markets are behaving normally and when they are not. That distinction is often the difference between reacting late and adjusting early. Markets do not reward certainty, they reward preparation. Nothing discussed today guarantees a specific outcome. There is no single data point, no deadline, and no indicator that determines where price must go next. Markets remain adaptive systems, and they often resolve pressure in ways that surprise even experienced participants. What matters is not being early, loud, or dramatic. What matters is understanding risk, structure, and time. Periods like this test discipline. They tempt investors to chase narratives, overreact to short-term movement, or anchor on a single scenario. Professional risk management takes the opposite approach. It emphasizes patience, position sizing, and flexibility. If conditions normalize, that is information. If pressure persists, that is also information. Neither requires urgency, both require clarity. This is not investment advice. It is simply how I am reading the market right now, by focusing less on headlines and more on how the system itself is behaving. In environments like this, staying informed, staying patient, and staying risk-aware matters far more than being right about tomorrow's price.